It's time now for today's strategy session as stocks are falling, as tariffs are top of mind for investors once again, and the Fed offering little comfort about their ability to grapple with the implications from President Trump's additional tariffs set for April 2nd. Chair Jay Powell bringing back the idea of transitory inflation, saying it could be the case for rising costs that come with these tariff policies. Joining us now, we've got Robert Sockin, who is the senior global economist over at Citi. Good to see you here this morning, and thanks for joining us. So I believe exactly what he had said is that, as he had mentioned prior, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by them, if it's transitory. And of course, that is where the markets have a lot of PTSD, and perhaps economists even like yourself, Robert. So just take us into the thinking around how transitory some of the tariff impact to inflation could be and the time span that would really be appropriate to consider that with.
Yeah, absolutely. And this is really the key set of issues that economists, markets, and the Fed is grappling with, that when you have tariffs, it's going to affect the growth side of the mandate by lowering growth and the inflation side of the mandate by boosting inflation. And those two things tell you to do different things with monetary policy. We think that even though you're going to get probably a similar drop down in growth this year as you are a boost to inflation, that is, we think the tariffs are going to lower U.S. growth by about 50 basis points this year relative to a no tariff baseline, and raise inflation by about 50 basis points as well. We think that the growth concerns are really going to dominate in the Fed's thinking. And if you get worse scenarios than that, you could see the Fed cut rates more than we're thinking and markets are thinking, and that really they are going to probably look through that inflation boost. Now, there are risks here. The risk, of course, is that even if inflation from tariffs is temporary, you could see that bleed into inflation expectations, and that is really when the Fed would start to get concerned about the inflationary effects. But at the end of the day, I think the growth effects are likely what are going to dominate their thinking. And so if you get substantial tariffs, you're likely to see the Fed lean into easier policy.
It sounds like you're in the camp that we could see a potential growth scare. Is that right?
Yeah, absolutely. I mean, right now, fairly constructive on the U.S. outlook because the data still, while noisy, look pretty good overall. We're still expecting growth kind of in the high 1% range for the U.S. this year. We were expecting growth closer to 2.3% before the tariff effects. But that being said, you are seeing a lot of noise in the data. You've already seen some of that in Q1. And if you were to get substantially more tariffs, you could get more of a growth scare later on, particularly as the economy starts to feel those effects and slows down a bit more genuinely. And if those tariffs start to really affect how much consumers and businesses are willing to spend, those secondary uncertainty effects, which we're potentially seeing a hint of in some of the survey data, which have softened in recent months, then you can really get those fears growing more and maybe even becoming self-fulfilling. So, while we're still constructive on the outlook, I do think recession risks have grown over the last several weeks.
To what extent does industrial production really come into play there? Because we did see a surprise to the upside, but in broader context, the outlook here on the manufacturing side as part of the industrial production, that certainly has had the looming cloud of tariffs over top of it that has been a consideration.
Yeah, absolutely. And I would make a few points there. One is, the manufacturing side of the economy has not really been what's driving U.S. growth over the last few years. It's not been what's driving global growth. It's really been about services sectors. It's mostly been in the U.S. about consumers spending on services. And so that has not been the engine driving the U.S. And I think if we see soft manufacturing activity going forward, that doesn't necessarily mean that the U.S. won't have another strong year. The second point, as you note, is the tariffs kind of have mixed effects in the sense that the long-term goal is obviously to bring back manufacturing production to the U.S. That would probably take a lot of time, even if it does occur. And at the same time, tariffs are likely to up costs for a lot of producers in the U.S. So it's a very complicated picture. And that's why overall, even if the tariffs have some long run benefit, they do bring production back to the U.S. In the short run, we do think that the growth effects are are particularly negative.
And so as we've been focusing in on the inflationary side, the other side of that, of course, for the Fed is the employment side, where both in the public sector and the private sector, where the private sector is not seeing attrition fast enough, at least in the case, I believe, of Morgan Stanley, then you could see more layoffs come forward versus in the public sector, everything's been focused around efficiency and what efficiency looks like as related to current headcount levels. How does that ultimately make a trend that the Fed then has to pay attention to? And could they be forced into a position where they need to take some policy action that we weren't even anticipating?
Yeah, absolutely. And the labor market is absolutely key to be watching here. And I think that one of the most important indicators that you highlighted is layoff activity. So far, layoff activity has remained relatively low. And that has continued even as you've seen a lot of this uncertainty playing through both on the public side and then what it means for the private sector. So we're watching all of that very closely. In particular, with the DOGE policies and efforts that we're seeing in Washington, is that having spillover effects to other parts of the region and into the private sector? And when you look at layoffs in the Virginia area, in the Maryland area, around kind of that DC ecosystem, you're not really seeing a substantial pickup in layoffs. So that's another thing we're watching closely in terms of risk. But right now, layoff activity remains relatively low on the private side. And you're even seeing on the public side some pushback against having that rapid adjustment, pushback against some of those DOGE efforts. Now, for the Fed, they're absolutely watching the labor market closely. And if you do see a sharp deterioration, you would likely start to see it in layoffs first. And then that as well could lead to those a more dovish stance that I was mentioning before, if you get substantial tariffs and a substantial fall in growth and substantial drop in business and consumer spending due to uncertainty. So I would be watching that layoff activity closely. Right now, not a whole lot to see there in the aggregate, still relatively low layoff activity.
Robert, good to have you with us as always. Thanks so much.
Thank you.